happening with China. Just set the stage as far as your background, who you are, and what you do.
Sure. So I am the CEO and founder of a company called China Beige Book, which set out over a decade ago to try to provide the world's only independent read on the Chinese economy. We've spent years looking at official Chinese statistics. I think people have come to the conclusion after many, many years of looking at them that not all are reliable and should be used for important things like investment, strategic planning. But beyond that, the larger problem is that there's just not enough data on the Chinese economy. If you want to be doing something dynamic, you want to be expanding your franchise, you want to understanding the policy and macro headwinds, there's just not enough information coming out of China. So what we decided to do, back in 2010 was put together a large-scale private survey network that was surveying back then thousands, now many, 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 many thousands of Chinese firms across the entire economy, across all the key sectors, across all the key 37 discrete subsectors, across all the geographic regions. And we designed it to not have any biases in the same way that the various PMIs do. So we're not biased towards large firms or state firms or coastal firms. We're not biased towards small firms or private firms or firms in the periphery. We try to paint a picture of all of China, not just the one China that usually gets reported, which is what happens in Beijing or what happens in Shanghai with larger firms, state firms. We want to have a picture of all of China. And beyond just the growth picture, it's important to understand things that are going on in inflation. We're finding out that in spades the last couple of years, the labor market, what's happening at jobs. Because when you look at from the policy side, what the Beijing really cares about when they're making policy is not the PMI, not the GDP number, but the jobs number. What's that kind of job stability do they have? And I guess most important of all is credit. So what's happening in the credit markets? What's happening in the shadow credit markets? How is the government stimulating these or not stimulating? And what is it seeing that makes it think that it can stimulate or doesn't want to stimulate? So these are questions that are hitting us pretty hard in the last several months as everyone's trying to call a pivot in China credit policy. But we're happy to be doing what we're doing, and it couldn't be more of an exciting place to be in watching China right now.
So give us a sense of the kinds of questions that go into that survey, and how does it give you a quantitative sense of what's happening?
Yeah, so we approach it the same way other surveys have, including the PMIs. We ask, have things gone up, down, or stayed the same? So generally, we're looking at corporate metrics like profits and revenues and cash flow, sales volumes. We look at sales prices and input prices and wages. So we're trying to figure out whether things are going up, down, or sideways. It's aggregated over tens of thousands of firms over a given year. Back when we were starting, we were a quarterly survey and we were doing 1,200 firms a quarter. Everyone thought this was this amazing, how could we even get that many? Now we're doing roughly that number per month, and we're releasing it more often. So we're trying to do is we're trying to get a big picture of China. We're trying to get the directional story right, but we're also trying to point macro pivot points, sectoral pivot points. And occasionally there's questions where we ask for very specific answers like cost of capital. We want to know how much firms are paying. So, but generally speaking, it's a series of diffusion indices.
And I'm just thinking out loud here, are the answers anonymous, or do you know where they're coming from? The only reason I ask that is, maybe there might be some concern by respondents that the Chinese government might be seeing how they're answering these things. So how does that get reported to you?
Yeah, we will never, everything is completely anonymized. In this day and age, there's incredible privacy concerns and privacy security. Everyone's really worried about this type of stuff. One of the reasons we were able to do what we've done is that we weren't just a bunch of China experts who landed on the ground in Beijing and brought out a yellow notepad and started asking questions and surveying. We were put together in large part by people who are professional pollsters, professional survey experts. They know how to gather information. They know the proper way to do information gathering. So there are, very, very clear boundaries on this. And, we're never trying to get at the underlying company. What we're trying to do is get the aggregate picture, because the individual responses are only significant when they're aggregated into something much larger, which is a broad picture of how the economy writ large is operating.
Right. So sort of a wisdom of crowds approach. So based on that, how divergent are the surveys from what you see on the official public data, right? How big is that spread?
Yeah, so it depends. When we were looking at the COVID lockdowns and then China's rather remarkably quick recovery out of the first COVID shutdowns, I guess, in January February, March 2020, we saw a lot of the same things that official data showed. So they, coming out of the lockdowns, they rushed manufacturing back up. There was an industrial side. Factories were opening up quick. They're getting back up to capacity. Workers were getting shipped back to their factories. Work weeks were being extended. And so on the industry side of the economy, you saw big things happening. And on the other side of the economy, you're looking at retail and services and other things. They were hit very, very hard, as they are, everywhere where COVID strikes. So I think with the initial picture we got of the Chinese economy and the Chinese recovery from COVID was very similar to what official data showed. And that was interesting. Now, they claimed that there was 2.6% year-on-year GDP growth, a number of weeks and months after the lockdown. That was nonsense. There was no year-on-year GDP growth anywhere around that time. But the general story was pretty similar to what we saw and what they saw. Now, we start to go very divergent ways quickly enough because when we looked at everyone as they saw China economy get back up to speed and then move forward, there was this widespread expectation that there would be a consumer spending surge, that the recovery would normalize. Industry was fine, but then retail and services would get back up to normal, and then you'd have a economy running like it used to. And so there was a widespread expectation, all kinds of consumer spending surge and bigger numbers, and we didn't see any of that. We saw some of the weakest retail data we've ever seen in the history of the survey in mid-2021. Sure enough, it was on a lag, but then China's retail numbers came out, and everyone was shocked, and we weren't. So in that case, we had this story, but it was just happened to be several months ahead of when everyone else got the memo. And then there's other times in which, we see something that's very different than what's being reported. And, this happens occasionally. But one of the things about the Chinese government smoothing out a lot of their numbers is when you take out the downturns, then you also take up the corresponding upturns. So at any given time, our information, our data may be a little bit better than official data. It may be a little bit worse than official data, or maybe altogether different. So it's a very much a different story each time.
And from a practicality perspective, is there a leading nature to your findings when it comes to the Chinese stock market? Yeah, obviously, that's a loaded question, right? Because it depends on the lag, right? But talk to it from a practicality perspective. How do maybe some of your clients look through those surveys, those conclusions, and determine what to do with it?
Yeah, so stocks are interesting because there is no historical correlation, the real economy and the stock market over time. It's not in our data, not in official data, not any data out there. The stock market operates as a very different beast than the real economy. So from that sort of 30,000 foot perspective, the answer is no. We're not predicting moves into A shares or out of A shares and similar things. However, what's the biggest story of the past year? The biggest story, at least the past half year plus, has been, why no stimulus in China? Why has everyone been calling for stimulus? And, look back at what happened last fall. A lot of big name institutions were calling, the beginning of the party Congress run up. So, as everyone knows, 2022 is a huge politically sensitive year for China. Xi Jinping in October, November is going to be going for his third term, maybe more. And every 5 years you have these party Congresses. And historically, that has been a massive, stimulus period. So the monetary spigots get turned on, big time fiscal spending, infrastructure gets built out. There's a rhetorical talk up of the stock market. Everyone gets in, great things happen. And that's what people are used to. And I think a lot of people out there at these institutions were just assuming, hey, this could be another big year for stocks and another big year for stimulus because that's what we're used to. But when we were looking at our credit data, not just earlier in the year, but straight through the middle of the year, straight to the end of it, straight into 2022. We saw the tightest conditions we've ever seen by far, the China Beige Book survey. So there was nothing percolating under the surface. There was never the possibility that they were starting up, a big credit easing move. It was, if you look at what firms were actually reporting, if you look at what conditions actually were on the ground, then it totally undercut the idea that we were moving into a traditional, big time 2022 party Congress year of big stimulus. But that didn't stop everybody from trying to be the person or the firm, or the talking head on CNBC or Bloomberg that called the pivot. And so what you saw in September and then again in December, a lot of firms saying, go all in to A shares, go into the stock market. We have a good feeling about this. And then when they didn't see anything happen at the beginning of the year, they said, let's double down. If you double down, we've got a really good feeling about this still. Enormous wealth has been lost by following these instructions because they weren't based on data. They weren't based on anything that was actually happening on the ground. They were based on this idea that, China watchers for 20 years have been taught that the Chinese like to juice growth and that they like to juice growth a lot in a party Congress year. And so let's get ahead of this curve and pretend we're doing research, pretend we're showcasing our data and urge clients to go in. And then, we'll claim that we show them the way. But what's happening is the economic growth model in China's changed. The economic policy playbook has changed. The stimulus playbook has changed. The priority on high growth at all costs has changed for the Chinese leadership. And because of that, you're getting a lot of predictions, a lot of particularly bullish, particularly going to the stock market type predictions that we've heard over the last, 2, 4, 6 months that have been not just wrong, but just disaster stories.
And presumably that's because of inflation, I'm going to assume, right? That the Chinese government views inflation as more dangerous than the benefit of stimulus from a political election standpoint. So maybe that's a good pivot. Inflation's, of course, on everybody's mind in the U.S., but how's that picture looking in China? Because a lot of the discussions around inflation are around cost push, supply chains. But in terms of the local population in China, how does that picture look from what you've seen?
Yeah, not nearly as bad as everyone thinks. So, in 2021, one of the big questions for markets was, can China control potential inflation? It was a global question, but it was a real question for China because there was such a reliance on commodities. And what we showed straight through 2021 was that they were able to get through it very, very well. That you did see inflationary pressures in a very narrow channel, which was the commodities, the manufacturing and property channel, which the government stepped in to control at times, but kept inflation manageable, even though you saw some big PPI prints along the way. But in terms of broader inflation, you never had broader inflation for consumers. You did not have broader inflation for production outside this channel. And so the inflation story was never quite as worrisome as people were, as people were focused on. I think the Chinese government is probably very happy with the job they did in 2021. When we talk about the reason, you said inflation was a reason that made them hesitant on stimulus. That's part of it. That's certainly part of the recipe. But I think there's even something bigger at play. And that something bigger at play is the fact that the Chinese economic growth model has changed. It's run out of road and it's not disintegrate as much as the party has identified that the vulnerabilities in this economic growth model are a real threat to long-term party governance, to, party control. And so they have stepped in over the past, year and a half and actively slowed the economy down. And I think that's underappreciated by people. You had a massive financial sector de-risking starting late 2020, early 2021. We're still seeing it. We saw property sector de-risking, which went on everybody's radar because the Evergrande crisis was impossible to escape that as being this big, scary headline. But what's been happening is there's been a real move away from reckless credit expansion and this stimulus playbook, which used to inform outsiders that, hey, every time the Chinese government sees weak data or feels insecure, they're just going to stimulate the heck out of the economy. And we're moving away from that. And we're moving away from that in large part because the Chinese Communist Party wants to move away from that. So a lot of what we're seeing right now, certainly inflation is a factor. Certain, dynamics of global central bank hiking, that's a factor. But I think that the number one reason you haven't seen big stimulus in 2022 is because that's no longer the way that Xi Jinping wants to run his economy.
All right, so let's talk about the property side for a moment, because as you noted, everyone had Evergrande on their minds and then suddenly forgot about it 2 days later. Talk through, sort of the reality of real estate in China and how you think they are able to avoid contagion. Because everyone obviously goes to the 2008 crisis, right? That's obviously the first thing they go to when they think about China. But set the record straight on that.
Yeah, well, the first thing we put out, right, is that, even before Evergrande hit the headlines, because actually we knew this was coming. And we knew this was coming because when you look in China Beige Book data, not just for the third quarter, for the second quarter, we saw severe distress in the property sector. Everyone says, oh, defaults are this bellwether, defaults are the signal. Defaults are not the signal people think they are because they're stage managed, they're politically approved. There's not that many of them. The real bellwether, the real signal of stress in the Chinese economy is related to capital raising. And what we saw in the second quarter were property firms at an incredibly high rate being tossed out of the traditional banking system. They couldn't access capital. Loan rejections hit the highest level we've ever seen inside the property sector, and they were being forced to run scrambling into the shadow finance system. And that happened again in the third quarter. And so we saw 2 straight quarters where there was a very clear push from the government side to restrict capital to property firms, to most property firms. Firms who are accessing were paying more. Firms that were accessing the shadow finance system were paying much more. And so, you had this system where they were really engineering a very different dynamic inside the property sector. Now, what was happening there? If you step back from the little picture and you go back to the big picture, what they're trying to do is do away with property as this sector, which they utilized reckless credit expansion in order to juice growth levels. So what you've seen for years is, the government sets a target, a GDP target, and the economy is cruising along, and it's not going to hit that target without some more juice. And so you give a lot of money to a lot of credit goes into the property sector. There's an infrastructure boost. They're building a lot of things. Some of them are bridges to nowhere. Some of them are legitimate. But you see lots and lots of capital just flowing into property. That gets the growth numbers up, and they hit their growth number. But what happens over time is that so much of that credit is going into non-productive uses that you've got a real problem with non-performing loans over time. And, anyone who's studied China knows that non-performing loans are this gigantic looming shadow over the economy. But what I think it's important here is not whether, we think, outsiders think, non-Chinese think that we're approaching some sort of limit to this. It's that the party itself is worried enough about it that they decided to downshift property. And so property was decided, they'll know it's no longer to be this sector that is going to be, bloated balloon. They're going to try to deflate it. And they're not going to want to cause systemic havoc, but they need to teach people, need to teach firms, need to teach borrowers that the credit's not always going to be there. And they need to act more economically, like a real market economy. So we've seen this move to deflate the property sector. And we saw it months and months and months before Evergrande. But the reason that Evergrande, so I've talked about why Evergrande is a problem, it's causing dislocations. But the reason Evergrande was never going to become, a systemic contagion is that the Chinese system is not a commercial financial system. The Chinese economy is not based on a commercial financial system like the West is. What you have is a situation where basically the party controls all the counterparties in the economy. They can tell if you have a stop up. What was Lehman? Lehman was a counterparty freeze in part. Nobody wanted to lend to each other. No one wanted to buy from each other. No one knew what anything was happening. You don't have that in China because China can order all the counterparties to interact. The buyers, you tell them to buy. The lenders to lend. The suppliers to supply. And you keep the economy moving that way. Now, that's great in terms of avoiding an acute crisis. What people were worried about systemic contagion, that was never in the cards. But what it does over time is it creates a lot of non-productive growth, and it sort of descends you into a stasis of zero growth environment. So it hurts you over time, and I think that's what the party is worried about now. That there's been too much of that, and there needed to be movement away from that old economic.
I wonder if you think people underestimate how much control they have, right? Because from a U.S. perspective, it sounds crazy to think that a government has that much accuracy when it comes to a very large economy.
I think they do underestimate. I think outsiders, that's one of the big misconceptions on China. There's a lot of people out there who said, oh, the U.S. had its, 2008, and Europe's had its 2008 type of crisis. Well, China's next. Japan, who knows? But China's next. And I think what they're overlooking is the fact that China is a non-commercial financial system, and as a result, it can order counterparties to do things. It can ensure that for instance, forget rule of law. If you need a big tidal wave of capital to flow from one side of the economy to another to patch up holes in defaulting firms or in other problems, asset management companies that need more capital infusion, whatever it might be, you just order that capital move from one side to the other. It's just sort of swooshing back and forth. Now, again, that's really, really helpful when you're trying to avoid an acute crisis. But in terms of long-term trajectory, what that does is good money is constantly chasing is after bad. You're constantly increasing non-productive growth, and your productivity slides over time, and your non-performing loans go up. And like I said, I think we're at the point where the party has said enough is enough. We don't know when there may be a formal the system would crumble, but we don't want to ever get to that point because we want to stay in control forever. So they're moving proactively away from this model, and because they're moving proactively away from their model, they're governing different than they had in the past. And this is why all these China watchers out there looking for a repeat of 2016, 2017, or some other historical example they're basing their model on, they're going to be wrong. They're wrong now. They're going to be wrong in the future. China is slowing down much more precipitously than people understand. It's going to slow down much more in the future than people understand. And when you look at growth going forward, GDP number is going to be an entirely political number. And people laugh when I say that, say, wait. You started your company over 10 years ago. You were saying that back then. True. There's always, Chinese economic numbers have always been political. But going forward, they're going to be entirely political, because if you actually de-risk your economy full bore the way that we're talking, and you didn't have any worries about social instability or anger at the government or defaults and other things, you just wanted to get to the end. And, China would be growing at, say, 1 or 2% growth at the end of the decade. Let's say 2-3% growth, because it gets people less upset. So any number that they'll be growing over that means they're just dipping back in their old playbook. They're juicing things enough because they want to make sure optically that they're looking like they're control. They're easing things down. They have a domestic audience to play to. They have an international audience to play to. So whatever number above, say 2% will be how much they dip back into their old playbook. And that will be based on, how comfortable they feel with their own economy, how the global economy is looking, or what's the, global trade look like? Is there a trade war going on? What's geopolitically happening? And so I think people have not yet, by and large, shifted their attention to the new way China's going to operate and the much lower growth China's going to have in the years ahead. They're still stuck with these IMF and World Bank predictions, which say, we'll go down 1/10 of a percentage point in GDP a year from now, and then maybe 0.2 of a percentage point in GDP 2 years from now. That's the old model. That's dead. It's going to be wrong. No, we haven't talked to the yuan or the yen yet, so this is fresh territory. Anyone who follows us on Twitter, I hope everybody knows that we've had our thoughts on the yen and Kuroda, despite the fact that people didn't think he could possibly withstand this, but he has. So there's an interesting question down the road about how the Chinese view what's happening in Japan. But let's look at the yuan straight away. The yuan is not a free-floating currency. It is pegged to the dollar. Now, I know people think it's pegged to the basket, or it's pegged to the dollar. That's the way to look at it. And it has been range bound for years and years and years. Now, my friends in the Forex world say, there's a big range. They've gone down to 6.2 and they've gone up to 6.9. Well, look, there's a political range that's acceptable for the currency. And maybe the PBOC wants to throw things off a little bit. They don't want it to be a one directional trade. So they'll put a little bit of excitement into it. But there's a window a range to which they're going to keep the currency pegged versus the dollar. Now, a couple things could happen to upset that apple cart, none of which have happened yet. And I don't think we're close to it yet. The first thing is you could have a surging US dollar. We are seeing a dollar that's strengthening, and that's one of the reasons everyone's talking about the falling yuan. But the yuan's not really falling against the rest of the world. It's the dollar's rising. So what they're doing against that is they're blowing off steam against the dollar, but they're not making major moves. They're not politically depreciating, devaluing the yuan versus all the rest of the currency. They're just trying to blow a little bit of steam against a very strong dollar. So that scenario, they want to keep it range bound unless something dramatic happens. The other thing, of course, is if things absolutely fall apart domestically. So if you have some sort of Chinese economic crisis, you have a full-blown COVID crisis, you have something else, and growth falls off a cliff. There are scenarios in which you get to a point where the leadership would probably break the glass, and then you move outside of the bounds. And you've seen in the past, the Chinese have moved outside 7 of the dollar, and they resisted it, and then they did it, and then they went back under. So there will be movement based on extraordinary circumstances with the dollar, with the Chinese economy, et cetera. But by and large, Beijing has one mandate for the PBOC, and that is maintain relative stability. And they want to maintain these windows, and they want to maintain a currency that's range bound, because the yuan and the Chinese financial system piggyback on the dollar and the American financial system and the Western financial system. So stability is the mandate. And that's, anything outside of extraordinary circumstances, that's pretty much what's happening. I like your word, necessity. The good thing about necessity is it's necessary. So they have no choice. So they're buying the bond. They want to diversify a little bit. They want to optically diversify even more than they're doing. So they'll be buying backdoor treasuries and other U.S. government bonds through the back door in Cayman or Belgium or Luxembourg, whatever it might be. By and large, they're stuck with the dollar. They're stuck with investing. What are the options to doing this? You're not going big in the Eurozone right now. You're not going in the yen and the Japanese JGBs. So what are you going to do? You can diversify a little bit towards those guys if you really wanted to. You could diversify a little bit to some of these commodity countries, which, with Australia and Canada and others. And that's what the world's doing. But by and large, there is the reason the U.S. is still the global reserve currency and will be going forward indefinitely until something, paradigm shifting happens, is that there's really no other alternative. So, the Chinese don't love doing this. It does give the U.S. some leverage, in the grand scheme of things, but it is necessary. And so this is the way it is for now. So it's not about wanting to be invested in dollar assets. It's a question of, is there any alternative to putting your huge trade surplus into dollar assets? And the answer right now is no. I like Zoltan and stuff. I think this thesis is nonsense. And we said so on Twitter when it came out. No, I don't think there's anything to that. I think you start getting your head spinning about, the idea. There's this idea that, okay, well, there's going to be some sort of China-Russia axis focused on commodities, and none of it really makes sense to me. I don't even really understand it, but certainly I don't think that there's some sort of mutuality of interest that'll lead us in that direction. So, I don't want to comment too much on it because I looked at it a little bit, but I didn't read the paper closely. I looked at the idea behind it. So, no, I don't think it's likely, but I don't want to critique someone else's paper that I haven't gone through with it.
That's like the anti-pundit response, by the way.
Trying desperately to be responsible. To be responsible. Yeah, I love that question because you teed up exactly the direction I would love to steer this. So you're losing, we just talked about how the Chinese economy is losing the property sector as a driver. So really another way of just asking your question is like, what's the replacement growth driver? And the answer to that is there is not one. And that's why you're going to see much slower growth going forward. Now, if you read state media and you listen to policy pronouncements, or you read a lot of the reports on the street that I'm not a huge fan of, you get this sort of mushy idea that domestic consumption is going to rise from the ashes like a phoenix, and that will drive the Chinese economy going forward. But that has never made any sense. And it hasn't just made sense because when we look at China beige book data 10 years ago, when we look at it now, it was never good, and it's getting worse, and it's quite terrible actually right now. And so there has never been this shift to consumption. There has been a move away from investment, which is part of what they've said they're going to do. But there's never been sort of a shift towards a domestic consumption-led economy. And why is that? Well, structurally, they're doing nothing at all to incentivize, a move to stronger domestic consumption. One of the ways, we talk about them being able to do this is they could, materially appreciate the currency. So you could put more purchasing power in the pockets of households to spend. They're not doing that. They want to keep the Yuan moving around. And right now it's going down before it went up, but they're keeping it stable. And that's very important for the financial system. So they're not going to toy with the Yuan in order to give some sort of bonus to consumers and households out there. What else could they do? You could transfer all these wonderful state assets to the private sector, the household sector. They're not doing that. They're doing the opposite right now. There's been this major centralization campaign, if anything, for a number of years. At least the second half of Xi's 10 years has been centralization more than anything else. So they're not doing that. Expand the safety net in a big way. And yeah, they're doing this in little ways, but is it enough to be able to not just shift things in this direction, but also overcome the enormous demographic headwinds that we're seeing coming up? No, it's not enough as is. It's certainly not going to change the structural dynamics in China. So this is what I always say every time I see one of these nonsense reports about how the Chinese consumer this or the Chinese consumer that. It's a marketing ploy. It's a marketing ploy by people who are trying to get you invested into certain things in China. It's never been true. If they want to structurally incentivize domestic consumption, there are ways to do it, and they have not chosen to do it. And by and large, the reason they've chosen not to do it thus far is because they relinquish centralization. They relinquish party control, and they don't want to do that. They want to empower the state. They want to keep more control. So there's a guidebook to how to do this. They just don't want to read the guidebook, or they read the guidebook and they don't like where it's going. So the biggest lesson I think you can learn is that don't take for granted what they're saying. Ask, are they doing what they're saying? Are they walking the walk when they talk the talk? And on consumption, the answer for not just months, not just years, but longer than that has been no. It hasn't. They have not been doing what they should be doing in terms of empowering domestic consumption.
Before I go to Gnostic, can you talk through a little bit more on the demographics? We always hear about demographics being poor in China, but talk through some of the hard data on that.
Well, I mean, you've got this problem where you got a bunch of demographic headwinds, but the reality is the big issue is that China has gotten old before it got rich. So people love to make the comparison between China and Japan. And there's a lot of comparisons to be made. But the difference is that Japan got rich and then it got old. And now you've got this sort of zombified economy and zombified economic system, and it works in this peculiar fashion. And they're okay with it because Japanese citizens are relatively well off. So they're okay with it. The problem with what China's facing is, they haven't made the jump in incomes. It's still a relatively poor to middle income country, and it's very old now. And you've got, you look at any of these charts on working age population just falling in years ahead. You look at gender imbalance. There's too many males, not enough. You talk about the idea that, one child is going to be supporting two parents and, four sets of grandparents. And how does that possibly work? That goes back to our domestic consumption. How you get people to spend when they're saving up to keep, all these relatives above them in an inverse pyramid well off and pay for their hospital care and pay for their old age. So you've got these enormous headwinds in the short term. What's not often appreciated is some of these things are actually helpful to China's ability to make a transition. If you've got fewer workers every year, then the dislocations from restructuring your economy are less. You have less potential for a jobs crisis. You have more ability to shift things around. So some of these headwinds are salutary. They're tailwinds for the short term. But when you get in the midterm, really, it's severe demographic headwinds. And the talking point for why everyone has their own beliefs of whether China is going to rise or China is appearing at peak. But to the extent you look at the latter theory and you think China's peaking, it used to be all the talking points were about Chinese debt. And certainly talk about that. That's important. But I think top of everything is demographics. And that's really what's going to hold them back if that scenario plans out. So demographics are something that are going to be just an enormous headwind for China going forward, and in a much severe way than what we're seeing in Japan. Yeah, I think that's definitely a good way of putting what I'm saying. Because look, the problem here is that they've got to figure out how to run an economy that's basically been trained to run on enormous amounts of endless credit. Firms don't go bankrupt. Structured products don't default. Firms, you don't have massive job losses. You just keep people working. There's just not enough risk injected into the system. So part of this is you have to show that the government is not backstopping everything and that you can have failure. And then the idea is, okay, well, if once people believe that failure is possible, they'll start investing more sensibly. Firms that the Evergrandes of the world that were based on pyramid schemes, they will crumble. And the economy will take a hit, but it will not take a systemic plunge. It won't go into contagion because they're going to control this. They're going to control the slide, and that's basically what they're doing. They're trying to decelerate the model because the current high levels of growth and certainly past levels of growth were just based on a model that simply will not work anymore. I mean, that's why we keep going back to the fact that China's economic growth model, as we've all known it for years and years and years, is over, and they're moving to something different. So the answer is, can they get through this stage managed, downshift without problems? And the answer is no. Can they get out? Can they avoid a systemic crisis? Yes. Can they avoid a series of mini crises and investor panics along the way? I don't think they can. I don't think there's any group of humans in the world who could thread the needle on this without causing problems. They're going to go too fast or they're going to go too slow, and there will be problems. And there'll be even more problems because when you look at the economy, like, do you trust Chinese data? So, it's Chinese data come out and say, okay, everything's okay. Well, if you've been trained to not trust these data because they've given the wrong signals in the past, then investors cannot be confident that they're getting the right signals from Chinese economic data, that they're going to run screaming out of China anytime anecdotally they see things going wrong. You're seeing that in some ways right now. So this is sort of something we predicted back in 2016 when there was that crisis. There was a 2015 crisis which everyone thought was a crisis, but what it really was, we looked in our data and said, this isn't a crisis. Everyone thinks it is because the stock market's gone down and there's been a bad PMI reading and everyone thought there was a devaluation. Anecdotally, it scared people, but nothing's really happening. There was a perceived crisis. And, our data showed it wasn't a real crisis. But then, we got into 2016 and there was some capital outflow and a real panic. And you had what was not a big crisis, but a real panic. Real panic. And that was real. And what we said back then was, every 18 months or so, it's very likely China's going to have one of these panics, because as they are as they are managing their economy to this downshifted restructuring, it's going to be very hard to do it perfectly. Nobody can do that. Now, we had a little bit of a respite during the Trump trade war period, because at a certain point, I think Chinese leaders looked at each other and said, the most important thing right now is to rally around the flag and to resist the idea that we're weak with Trump's tariffs and this trade war. And so we're going to stop doing what we've been doing. And so there was a period in which you didn't see this China panic. They supported the economy more than they wanted to. But now we're back, and they're engineering the slowdown. And so we're at a point going forward that you're gonna have bad news out of quite often. And some of it'll be real and some of it won't be. But, this is why we exist. We want to provide what the real story is, and sometimes things are better than you think, and sometimes they're worse. But when you don't have visibility into what's happening in the economy, that's when people get in trouble, because you can't base it on some growth model and some playbook that you learned when you were, 15 years ago that you think still in place, because all that has changed. Yeah, sure it has. I mean, you bring up a very good point, which is, everyone thinks that China is this black box economy. And sure, in some ways it is. But in others, there's a lot of policies that were written about, months, years, sometimes decades ahead of when they were done. And they're making very clear what their priorities are, and the way they would like to make policy, and the direction they would like to steer their economy, and the way they would like to evolve, their economic model. All this is out there. Now, most people aren't trained to go look at it and don't know what they're looking at if they did see it. But, the reality is that a lot of these things are foreshadowed. So, you want to talk about this economic growth model debate. I've been traveling to China. I think I started traveling in the 90s, but, I've traveled to China many, many times and had this discussion both on American soil and in Chinese soil with many Chinese economists, many Chinese, officials, and said, look, here's what's happening. You may not want some guy from the West telling you how to run your economy, but here's what we see and here's what you should do. And there are plenty of Chinese economists, and have been for many years, saying the exact same thing. One of the things that Liu He was recognized as, Xi Jinping's right-hand man, was recognized for years. He was highlighting these problems. He was one of a group of, they were called reformers, which I'm not sure is the right name, who were identifying these problems long before they were acknowledged by, more broadly. And the biggest problem with this is not that this debate doesn't happen in China. It does. It is very active, and it has been for years. The problem is that China watching industry in the West has focused on the China miracle. Everyone in China doing economic policy is a bunch of economic magicians. They can make numbers appear at 8% or 6.8% or whatever it might be forever. And so stop worrying about changes in models. Stop worrying about the politics. Just rubber stamp a number and just bank on it for the next 5, 10, 15, 20 years. Now, all we dealt for the first 5 years we were up and running is people in the West saying this. And if you look at what even the IMF and World Bank are saying right now, I spoke at a big conference in Singapore, Bloomberg New Economy, and you meet people and very sophisticated China watchers, and they're out there saying, look, China's going to go at 5 to 6% forever, because they can and they want to. No, they're not. But, in the West, there's this belief that, hey, we've seen them operate and defy economic gravity for so long, they can do whatever they want. Well, they didn't defy economic gravity. There were costs. And now there's a change. And the change is partly the end of the model as we know it. And it's partly the party guiding us to a safer place where there's going to be slower, healthier growth, and where they can build, a new social compact with the Chinese people. So a lot of big things are happening right now. And a lot of it was foreshadowed in Chinese writings, in Chinese speeches in the past, but stuff doesn't get reported in the West. All we heard about for like 10 years was investment banks, railing on about, 1.4 billion Chinese consumers. Everything should work in China because you'll sell 1.4 billion of them. And it was nonsense then. It's nonsense now. But that's where we were. Yeah, we work with a lot of commodities firms now because we come at it from a different angle than people who are obsessing over day to day prices, and so we have very different views than some of them. And look, the important thing here is to differentiate what's happening in the very short term with what the longer term dynamics we're seeing in China right now. You actually have two different things to worry about. On that one hand, you have a slowing economy, which is creating disinflation. We're seeing disinflation in our recent April data. We're not seeing inflationary pressures. We're seeing pushes down on prices and other things in the short term. On the other hand, you're creating a system of supply chain snarls that's going to create inflationary pressure elsewhere. So you've got a whole bunch of dynamics, and people are trying to parse through what this means in the short term for commodities. Then they announce a all out fiscal stimulus, which some of you might have heard. We are skeptical they actually mean that. That's more of a talking up the market thing for the most part. But that sends prices up, and then you get a lockdown and sends prices down. It's not always easy to have a set thesis on that combines all these elements. But what you can do is look at the longer picture. And one of the reasons that we have been so loudly against this idea. Goldman's always talking about a commodity super cycle. No, we don't. There's no commodity super cycle. There's never going to be a commodity super cycle in the near future. Now, was there going to be a commodities rally this year? Sure. I mean, we said, look, you got to distinguish the fact that people have questions over the dollar. They've got questions over supply chains. They've got questions over trade. You have all the conditions here for a beautiful commodities rally, multi-year commodities rally. But when you're talking about a commodity super cycle, you cannot have a super cycle unless someone has this definition of super cycle that I've never seen before. You cannot have a super cycle without foundational demand. And the foundational demand in the last super cycle was China. And China's going the other direction. So, how much are they going to go and how fast are they going to go? Some of that story may be written right now based on what's happening and how the shocks to the system from COVID and lockdowns and slower growth. But overall, you are not going to see China as this foundational demand as you have in the past. It's probably going to be, a factor that people overestimate even now. So you don't have this foundational demand. Where else are you going to have the foundational demand? It's not going to be the United States. I hear India. Good luck with that. Anyone who's studied India knows the headwinds to that happening in a big way. Yes, there'll be a big move towards the green economy. Yes, there will be, drivers out there which make more metals and more different commodities more valuable. But where's the foundational demand? And I don't know anyone. I have not found anyone who does see it. What people are seeing is a commodities rally in the short term, and they're calling it a commodity super cycle for whatever reason, and that's something that we are not seeing. So differentiating the short term and the medium to long term here is important for us because we're seeing very different dynamics.
Yeah, I think that's maybe a good place to end it. So listen, for everybody that's been here, make sure you follow Leland, the China Beige Book Twitter handle. Check out Leland's research. Leland, I appreciate you spending the time, and thank you to everybody that participated here on the questions. It always helps me out when I have other people asking questions. So thank you, everybody, and Leland will be in touch.